I think there will be very little distress in multifamily. There will be some, absolutely. I mean, we went through, I would say, an 18 to 24-month period of people buying 3 caps that solve to sub 5 caps. That is the lowest, those are the lowest cap rates in place and forward in the history of real estate. Like, it's just insane what was happening. So those people are going to have refis, they're going to have rate caps, they're probably short on liquidity. So yeah, you're going to have some for sales.
Hi there, welcome to the Real Estate Reality Show. I am Adam Gower, your host and founder of GowerCrowd.com. We are focusing on the world of commercial real estate and what's going on in the markets at the moment, with a particular focus on distress and any opportunities that might deliver. My guest today is Max Sharkansky, who is one of the founders and principals at Trion Properties. Max and I know each other, met each other, and started transacting first during the global financial crisis of 2007, 2010. And Max has built a portfolio from when I first started working with him. When was that? Around 2000, I want to say 14 or so, 300 million in assets under management. I forgot to ask him how much he has under management at the moment, but steaming confidently towards 2 billion in assets under management. He's one of the brightest multifamily guys you will meet. And in today's conversation, we are going to talk about where the bright spots are in the multifamily world in America at the moment, where the worst locations are. We talk a bit about banking, the impacts of cap rate compression or cap rate increases, and cap rate compression. We also talk about what's going on with the financing, on the financing side for multifamily. Max has some really deep insights. He's extremely knowledgeable. You're going to enjoy the conversation with him very much. This series is being produced as a show on YouTube. Of course, it's also being syndicated across all podcast channels. So if you like what you hear in this show and you find it of value and useful in plotting your own investment strategies over the next few months, please go ahead to youtube.com/GowerCrowd. Take a look at some of these the shows in this series and put a comment in it. Subscribe to the channel if you would, and if you find it of interest, and also make some comments so that I can respond and we can have a dialogue over there. And of course, if you want to learn more about Max, go to GowerCrowd.com, find the podcast page. I'll put some links there to Trion Properties and to what Max is doing, his LinkedIn profile, etc. And while you're there, subscribe to our newsletter. There's a big red button on the page that says subscribe. It's totally free. It goes out every Wednesday, and we are tracking exactly what's going on in commercial real estate with a focus on distress and the opportunities that will inevitably come to investors over the next few months, even though Max takes a slightly different perspective. You're going to hear about that now. In fact, let's go ahead and turn over to that conversation with Max. Right now, Max Sharkansky, principal and founder at Trion Properties. Here he is. Max, super good to see you again. Thanks so much for joining me today. So my first question, of course, is what is kind of high level, what's going on in the commercial real estate market, particularly multifamily real estate there in the state of eternal sunshine? I know that you've bailed on California. And what are you seeing in the market overall?
Thanks for having me, Adam. There's a lot going on. It's changing almost daily, sometimes for the better, sometimes for the worse, sometimes a mix of the two. First of all, it varies market to market, right? So what we're seeing in the Pac Northwest or the West Coast isn't the same as the Mountain States, isn't the same as the Southeast, isn't the same as Texas. Florida and Texas are, of course, a little more related. They have a little more demand, more business friendly, more in migration. The West Coast is a little quiet. Mountain States, I would say, is kind of in the middle. very difficult to transact right now. There's not a lot of liquidity out there, especially on the equity side. It just seems like people are getting tighter and tighter when they really shouldn't be, because we're pretty much done with the rate hike cycle. You know, in my opinion, if you were going to be scared, your time to be scared would have been 400 basis points ago, not now when markets are, you know, fully priced and interest rates are fully priced out at 5 1/8 or 5 1/4, wherever the Fed funds rate is. So, you know, for all these reasons, I think we've all heard of the old saying, bull markets are driven by greed, bear markets are driven by fear, and it is peak fear right now. So that's really it. Fundamentals aren't too bad. They're picking up. We've seen a pickup a little bit in rents, a little bit in occupancy, you know, nothing huge, but you're seeing a little bit of that canary in the coal mine, because you had a huge drop in occupancy. And when I say huge, you know, huge on multifamily standards. So everything was running like 97, 98, 99% occupied, people jumping over themselves to rent apartments. And then all of a sudden it stopped and it went the other way. And we had been running most of our portfolio. And I think this was probably the case nationally at 91, 92, 93%, with softening in rents. And now it's starting to inch up the other way.
Well, so what was happening with occupancy? That's interesting. So it kind of surprises me. I always thought that occupancy has actually benefited from downturns because people sought rental apartments, moved in with each other. So what have you been seeing with occupancies?
Well, I think that's one issue, right? Like there's household deformation. There was so much inflation and there was so much rent growth. It just hit affordability so hard. People stopped. They moved back in with their families. They bunk up with roommates, their significant others, and they just pause and they stopped paying all these crazy rents because the rent growth, quite frankly, was not sustainable. So everything started to go in the other direction. There was some softening in rents and increase in vacancy. And now we're starting to see that firm up a little bit. We've signed a lot of leases over the last 4 to 5 weeks.
And what's happening to rental rates? I know you're there. Last time we spoke, you were seeing 24% increases annually there in Florida. What's going on now in the good states?
There are no rental increases. We're still seeing very positive tradeouts. So we have a lot of positive NOI growth from where rents were, let's say, 12 to 18 to 24 months ago. And I would say the main difference right now between Florida and some of our other markets is we have amazing renewal rates because there is so much in-migration and there is competition for housing and there is a finite amount of housing stock. Even though Florida is a very pro-development state, business-friendly state, there is just a tremendous amount of demand. And we're giving increases at 8 to 10% pretty consistently, sometimes more. And
on trade-outs, when somebody moves out. And
no. I'm saying on renewals. New lease trade-outs could be like on our property in Miami, or I think last quarter we're about 21, 22%, which is fantastic.
Mm-hmm.
I think our average renewal trade-out was around there too, maybe a touch lower. But we'll do 8 to 10% if the rent's closer to market. If the rent's very, very low, then we'll do a little higher. That's kind of how you get that, 18 to 20% blend. And I want to say in May, we renewed at like 75%. 75% said, we'll take the increase. We're not going anywhere. There's nowhere to go. It's still too difficult and too expensive to get an apartment, to move, and we're just going to stand pat. Whereas a lot of our other markets, like the mountain states and the West Coast, people are moving and they're getting deals on concessions and other kind of perks.
So you mentioned, actually it's perfect, you've segued straight into it. You mentioned there's some states that are better and some are worse. What's going on in the states that are underperforming? What are the dynamics that are affecting those states?
Well, I don't think it's a secret that California lost 500,000 people last year. There are some quality of life problems in places like San Francisco. LA's had its fair share of quality of life problems. I just read a study that was published on LinkedIn, and one of the most moved out metros, not MSAs, but metros was Portland, Oregon.
Mhm.
Portland's had some pretty bad quality of life problems. We own a lot in the Portland MSA, but we've had huge growth because of it, because we're in the burbs, we're in Washington County. So a lot of these people have moved into Washington County, and it's just been a huge boon, a ton of rent growth and a lot of growth, not just with apartments rents, but with the cities and the new restaurants and just, a lot of more vibrancy in these suburbs because of what's going on with the metros.
And what's happening on the lending side, Max? Is that tightening? It's getting harder to get debt.
So that goes back to where we started the conversation, where I said some good, some bad, some mixed. So right now, we actually are buying. We got a couple deals under contract. Equity, as I mentioned, is still getting. It's not hard. It's harder. So it's even more challenging than it was a few months ago and a few months before that. And it just keeps getting harder. But debt keeps getting better. And as you know, with the multifamily asset class, we've got Fannie and Freddie. And those are treasury-based loans. Those are not SOFR-based loans. And with Fannie, Freddie, and treasuries plummeting now, with 5-year, 7-year index, 10-year index, which are fall fairly flat, those three indexes, they've gone down to 3.3, 3.4 over the last couple of days. So you put a 170 spread on top of that, and you've got 5% debt. Like, we're buying a deal right now in the Mountain States, and we're probably going to lock rate at around 5%, maybe sub 5% at 4.9. If you can get your hands on a 5.5 to 5.8 cap and get 4.9% debt on it, you've got very nice cash flow out of the gates. You're going to have some rent growth over the next 5 years. The market's obviously going to improve. It always does. Exit caps are going to drop probably by 50 to 100 basis points, and you'll just do great on this stuff. And that's kind of how we see the world.
And what about LTV, loan to value, from lenders at the moment? Has that come down, or what's the story with that?
So that had plummeted, right? But now with treasuries coming down and cap rates continuing to expand, or at least stay high, let's say. But I would say, yeah, there's, depending on the asset class. When I say asset class, I mean asset class within multifamily, A, B, or C. You're going to have pretty good leverage. Like, going back to that deal that I just mentioned that we're buying in the Mountain States, it's about a 565, 575 going in, and we're getting 5% debt. And because we're getting 5% debt, we're getting about 67, 68% loan to value.
Interesting. And is that coming up, or is that going down? Like, what's the
70%.
trend with that?
Maybe actually, I'm sorry. Based on our last quote, we're at 70% loan to value.
And the trend in LTV is it went down, but it's coming back up. Is that what you're saying?
Well, it's coming back up because it's based on a combination of interest rates, NOI values, and if your NOI is flat, your value is flat, but your interest rates go down, your LTV goes up because you can service more debt.
And you mentioned cap rates. What have been going on with cap rates? Actually, let me ask you this question. Those who align interest as interest rates go up, cap rates go up. Would you agree with that?
Yes, as interest rates go up, cap rates go up. However, they do not go up basis point for basis point, and they never have, and they never will. So, as an example, rates right now went up by 500 basis points over the past 13, 14 months, 15 months. And cap rates, depending on the market, depending on the asset quality, have gone up probably 100 to 150 basis points, not 500. That's ridiculous.
I see. Do you think that will change, though, if rates stay where they are, and the impact of maturities and interest rate lag, et cetera, start to kick in over the next few months?
I don't think so, because you've got different indexes, right? So bridge loans are largely out of the market. Debt funds are largely out of the market for multifamily, at least. Yes, they're lending on hotels and retail and other asset classes. And there is some non-recourse bank bridge out there. We're getting one quote right now on a deal that we're trying to buy in Dallas. But for the most part, those are out, and those are all SOFR-based lenders. So you can go, again, Fannie Freddie's there for you, and that's a treasury-based lender. So you can get 5% debt.
And are you finding price discovery difficult in the market at the moment? Are sellers being realistic on where they are?
Those are two different things. I would say price discovery is not difficult because sellers, real sellers that go out at real values, they get multiple offers, they sell their price. I mean, well, again, that depends on the market, which market it's in. Bay Area, not multiple offers. Florida, Texas, multiple offers. But yeah, if you have a real seller at a real price and it's, a nice value add deal that's blank canvas or a core deal, they're going to sell it. The deal is going to trade. So to answer the first part of your question, yes, you absolutely do have price realization. The second part of your question, bid-ask spread, is very, very real with a lot of sellers. We just saw a deal in Miami the other day that I would have loved to buy. The seller was at 90. Maybe they said, oh, maybe we'll go down to 85. But on our numbers, which would 100% be in line with the market, we're not vultures, just trying to steal a deal. We're more like 70 to $75 million. And there's a lot of that in the marketplace, just not trading because of the bid-ask spread.
So what's holding sellers back then? What's holding this type of seller? You made the distinction, sophisticated sellers that know what's going on, who are realistic. Well, what's holding back the other sellers?
Well, those other sellers aren't necessarily unsophisticated. They're sophisticated enough to say, hey, I'm not a forced seller. I've got a great balance sheet. I'm not super compelled to sell this at a $20 million discount to what it was worth a year ago, 15 months ago. I'll wait another 12 to 18 months and sell it for a premium. And you can't really blame them.
Will they find buyers?
In 12 to 18 months from now? Of course they will.
I mean, if they're listing it today, will they find buyers? And this actually is going to start dovetailing into my next question, which is about distress and this new raft of sponsors that have come into the market since you and I met. But let's start with that. Are they going to find a seller if they've got it on the market today? And what characteristics would that buyer in this market today? What characteristics and how will they be underwriting a deal that you think is worth 75 or whatever and somebody else pays 85 for?
No, they won't find that $85 million buyer because they're just not going to stretch. No one out there is. Buyers that are in the marketplace are looking for something interesting, like, something where they can go in, roll up their sleeves, make some money on it. Maybe if they're buying something newer, like a core plus deal, they could buy it below replacement cost, burn some loss to lease, get, a little bit closer to a value add return without taking value add risk. So it's got to have, some sort of a story. To go overpay for something, there's just no reason to do such a thing.
So stories are very important and actually does segue actually into my next question. So what's going on in the market at the moment? To what extent do you see any comparisons with the world that you and I met in, which was 07, 08 during the global financial crisis, the last major downturn? Do you see any similarities? What comparisons or differences are there?
I don't see any similarities, no. Other than the fact that it's a bear market. That's it. That's the only similarity. Back then, we had 8 to 10% unemployment. People were losing jobs daily. Now we've got 3.5% unemployment. I could probably see that going into the low to mid 4s because there are a lot of layoffs. There is less hiring right now. Obviously, that's industry to industry, sector to sector. But the economy, Main Street, is getting softer. But still nothing like the GFC. You don't have subprime, which was a house of cards that was bound to collapse. The entire country was running a scam. It was a horrible, horrible house of cards, and that's not happening right now. Yes, you clearly had some unhedged banks, and there was duration mismatch, and they really failed banking 101. So you have some issues in the banking sector. There has been a banking crisis, but you and I saw a real banking crisis firsthand, not where 3 or 4 banks failed, where 300 or 400 banks failed.
Right.
So this is in no way, shape, or form compared in comparison to the GFC.
What about the challenges that, so let's just look at banks and the banking sector a little bit, because that is where we did see a lot of opportunity emerging during the GFC. What are the issues that regional banks are facing today, and are you expecting to see any opportunistic buys?
The problem with the regional banks, one of the problems is they're getting killed in the stock market. It's affecting a lot of their ratios. It's affecting their ability to lend. And that's bad news for the real estate community, because it's a leveraged business and we need our leverage. Otherwise, the real estate investments don't work. They don't pencil. So, with multifamily, we're fortunate. We've got Fannie, Freddie. We can go CMBS if we want. Other asset classes can also go CMBS, but it very much helps to have the regional banking sector active and vibrant and thriving. If you've worked with the big money center banks, they're not tailored to deal with people like us, mid-sized businesses, high growth, mid-sized businesses. Regional, we're a customer of First Republic, which I guess now makes us a customer of Chase. And we're a customer of Pacific Western, and we're a customer of Western Alliance. And these are all the banks you're hearing in the news. And, it's just very, very unfortunate because a lot of these runs are unwarranted. And if there was no FDIC cap, they wouldn't be happening. So these are healthy banks and they shouldn't be getting run on. It's very, very unfortunate.
FDIC cap, you're talking on deposits, are you?
The $250,000 cap.
Yeah. Okay.
Because if all the banks were insured equally, the money center banks, the big four, they have a $250,000 cap theoretically. But as we all know, they're too big to fail. They're SIBs, they're systemically important banks, and they cannot fail. That means they have de facto blanketed insured deposits. So you've got 4 banks in the country that are too big to fail and thousands of banks that can fail. So it's an unfair system. And in my opinion, my very, very strong opinion, we should not have FDIC caps. And however much that costs, however we have to pay for it, we have to pay for it because the playing field just isn't level.
But doesn't that just stimulate excessive liquidity again and lax standards, don't you think?
Not necessarily, no, because
the banks know that they've got that they've got a safety net that they can always fall into.
Well, no, because the safety net is failure. You'll still fail. It's the difference is the stockholders fail, which is the executives. So you still do have the alignment of interest. The bondholders fail, but the depositors absolutely should not be at risk.
And with the Fed, I saw recently tightening standards on banks. One thing that they've not done yet is to market. That was really what triggered a lot of the failures during the global financial crisis. If banks are required to market, if standards are tightened by the Fed, do you think that there will be more commercial real estate impact on those failures as their real estate lending really becomes more apparent and the distress that they've got on their balance sheets, rises to the surface?
I'm not a banking expert, so I'm not the best person to answer this question, but from what I understand, a lot of loans and a lot of the bank's assets don't get marked to market necessarily, unless, of course, as you know, they go into REO or they become non-performing, then you have more mark to market. It's more available for sale securities, bonds, and such. So, like, for example, what got Silicon Valley Bank into trouble is they were buying 10-year bonds at 1% to 2%, whatever it was.
Right.
Those blew way out and they had to mark to market. People started to run at the bank. They couldn't sell the bonds. And that was the end of Silicon Valley Bank.
Right. And are you seeing any distress in the market yet? Or are you anticipating any?
In multifamily?
Yeah.
I think there will be very little distress in multifamily. There will be some, absolutely. I mean, we went through I would say, an 18 to 24 month period of people buying 3 caps that solve to sub 5 caps. That is the lowest. Those are the lowest cap rates in place and forward in the history of real estate. Like, it's just insane what was happening. So those people are going to have refis. They're going to have rate caps. They're probably short on liquidity. So yeah, you're going to have some for sales.
And with loan maturities coming, you don't think there's going to be a big wave of that and bring some opportunities for Trion? Or is that more in a smaller scale assets than you typically look at?
We've written offers on some of that stuff. It already exists right now, and they haven't fallen in our direction. So we'll see what happens over the next year. Yeah, again, I do think there will be some, but I don't think anyone's going to be drinking from the fire hose and buying REOs and non-performing notes like you and I were in 2009 through 2012.
Right. So that actually brings me to this idea that since that time, right, during 2009 to 12, you've been through a major downturn. You're a seasoned sponsor. You know exactly what happens when there is a downturn. But since that time, we've had the emergence of crowdfunding, right? And you and I have worked on this and talked about this a lot over the last few years. And with that has been a new influx of sponsors who don't have experience of a downturn, together with an influx of retail investors who also don't understand what a downturn looks like, right? It's been plain sailing. Do you think there's going to be an impact on that community of newcomer sponsors and newcomer investors to the industry that will have an impact on the industry, on crowdfunding, if you want to use that term, or online syndication, which I prefer to use?
Yeah, of course, because you don't know what you don't know, right? So a lot of these younger sponsors were taking very high octane debt, floating rate, some capped, some uncapped. And there's going to be some pain out there. And several of these sponsors aren't going to make it to see the next cycle.
So is that where you're going to see opportunities, do you think? I mean, are you trawling for opportunities from that world of imprudent investments over the last, 2-3 years particularly?
There will probably, yes, there will absolutely be some opportunities for people who are selling at a loss or a break even or something like that. And that'll be a good opportunity for us to buy.
What are the kinds of deals that you're looking for? What kind of characteristics?
Well, our bread and butter has always been value-added multifamily, older vintage, like 1980s product, value-added multis. Blank canvas is our favorite, where it hasn't been touched. It's been owned by the same person 10, 15, 20 plus years, and we can go in and really do our thing. Then we're seeing some opportunities from developers. So we're under contract right now on a property from a developer. We got it off market. He's a merchant builder, so he builds, he leases, he sells, and we're getting it at a pretty good basis because we bought it off market.
So this is a building that was a ground up building that is not yet leased up. Is that the kind of thing you're looking at?
No, so in this situation, we would buy that. We have bought that. This one is leased up, and he just wanted a fast sale, so we wrote an offer and we're hopefully buying the deal.
And are you seeing any other ground up? So that's one in my discussions with other folk on this series and also with bankers. That is one area that is experiencing some stress. That is the ground up development where refinance or long-term finances the underwriting was completely did not account for the interest rates as they are today, and developments are coming under stress. Are you seeing more of that? Is that a worthwhile target for you to be looking at?
I've heard of a few. Again, we love that play. Like, we bought one deal during COVID in 2020 where the guy was finishing it. He was about 4 or 5 months from C of O, and we signed a PSA. We said we would close 2 weeks after he gets a C of O, and we'll take the lease up risk. He wanted his cash out. A lot of these developers, they either want their cash out, they went off the construction loan, they don't want to buy another rate cap, or a combination of the three. So yes, there's some opportunity there, and we hope to pick off, a few of those deals.
What are you seeing happening to rate caps, like over the last 2 years?
They're plummeting in price. So because of what's going on right now in the marketplace with the Fed funds rate, it's peaked. Everybody knows it's peaked. Futures markets think that the Fed will start to cut rates after the August break. So they seem to think that September meeting will be the first rate cut. I don't agree with that. I think the Fed probably holds out a little bit longer. But that said, because we're now in a marketplace where we're most likely flat interest rates for now, and then going down in the next 6 to 12 months, rate caps have become a lot less expensive.
When do you think all the sideline capital is going to rejoin the market? All this capital, it's these gazillion trillion dollars that's sitting on the sidelines waiting. When do you think they're going to make their play?
I think it will be the end of this year. October, November, call it Q4.
And what will trigger that?
I think it will be a rate cut. I think it will be confidence in the market that rates have stopped going up and will not go up. Inflation easing. I could see inflation. Well, if you look at the CPI print, it says 5 and 4 or whatever it says, which is complete nonsense. It's a trailing 12. It's terrible methodology. I think everybody knows that. So I think as the CPI print changes into 4 and then 3.5 and 3.25 and 3 and 2.5, I think there will be a lot more confidence in the market. I think treasuries continue to drop, treasury yields continue to drop, and that's when equity comes back off the sidelines and gets back into business.
Right. Let's wrap up with one final question. I'm trying to keep, as I mentioned, trying to keep these things down to commute time for the average commuter. So that's about 30 minutes. I did some research, 30 minutes, but LA, that 30 minutes is the 2 miles it takes me to get to my office.
That's right. I can jog faster.
All right. So exactly. All right. So let me ask this one final question. Max, what resources do you like to use to track what's going on in commercial real estate and multifamily industry? What are you using, media and otherwise, to see, kind of keep your finger on the pulse of what's going
on? What resources? We use a lot of the economic resources, CoStar, Reese, all the third-party services. We have a pretty big portfolio also that spans across 12 markets and 7 states. So we're looking at our own portfolio. We're underwriting dozens of deals, even though we have no intent to buy them. So the analysts, believe it or not, our analysts are actually pretty busy. Unfortunately, it's not anything that we're buying. Actually, that's not true. We are buying a few properties, but they're underwriting everything just so we can keep our finger on the pulse of the market. I think doing it yourself is the best way to do it.
And no kind of media in particular, any particular news channels or anything you like to track?
Wall Street Journal every Wednesday, although the Wall Street Journal and a lot of the mainstream media has figured out that people like reading about the issues in commercial real estate. So they're publishing it a lot more than once a week and they're putting it on the front page. So there's been some really good press in the Wall Street Journal. I mean, they're always the gold standard. So
Max Sharkansky, I'm going to probably get your title completely wrong, but principal and founder anyway of Trion Properties. It's always an enormous pleasure to see you. Thanks for joining me today.
Great seeing you too. Thanks for having me on.
All right, that was Max Sharkansky. Thank you so much, Max. It's always enormous pleasure seeing you and talking to you. And thank you for sharing your insights with us. This is the Real Estate Reality Show. We're trying to really bring the reality of what's going on in this market to you, dear viewers. So go ahead over to youtube.com/GowerCrowd, subscribe to our YouTube channel, make some comments over there, and of course, go to GowerCrowd.com, find out more about Max, more about real estate syndication. Over there, we have over 1 million words of content on the GowerCrowd site. Hard to believe. I can't believe I've actually produced so much, but it's all there for you. There's a nice search bar at the top of the homepage. You can search for anything that you're interested in. And while you're there, do please subscribe to our newsletter. Hit the big red button that says subscribe. It's totally free. We send out a newsletter with updates on the real estate syndication industry, on the crowdfunding industry every Wednesday. I'm sure you'll find it interesting. And that's it for today. Thanks so much for joining me again. Max, thank you for joining me. Thank you, viewers, for joining me. And for now, this is Adam Gower signing off.